How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you what is a single life annuity, and how exactly you could utilize a single life annuity for, specific retirement goals or specific income goals, for those later years. Now, single life annuity, a lot of people get confused thinking that this is only one type of annuity option. There's actually different variations. You could use different types of annuity contracts to produce that single life annuity result. For, let's just say, the bachelor, the guy who is, or the guy or girl who is 60, 62 years old, and they just basically have a lump sum of money that's sitting there. Maybe it's an IRA account, maybe it's in old 401k accounts, cash accounts. They could go and they said, listen, you know what? I'm done. I don't want to work anymore. I want to go and leverage these buckets of money, kind of think of them like buckets of money. I want to leverage this money in with an annuity contract. And that annuity contract is going to produce me a lifelong annuity stream, a lifelong payment, every single month, every single year, for the rest of my life. So let's just say if we have an individual that, they don't really have beneficiaries, or they don't really care about leaving their money to anybody. They just want to have the most max payout out of any type of annuity contract, or any type of financial contract out there for that matter. They could go take this money. Let's say if it's $500,000 and you have this individual and they say, okay, I want to turn this income on immediately. I'm 62 years old. I want to turn this on immediately. I'm a male, and I don't really care how much money it produces as long as it is the most amount of money possible in my specific area for 500,000. So you could go. This individual could take the 500,000, purchase something known as a SPIA, single premium immediate annuity, and turn on their lifetime income stream instantly. So maybe that out of that, $500,000, let's say, produces 50 grand. Every single year to the day that person passes away, they will be receiving $50,000 per year. Now, if they passed away after the first year, well, then the insurance company wins because and this is a very easy hypothetical example. Most likely, it's going to be a lot lower than 50,000, especially in today's interest rates and annuity rate environment. But let's say hypothetically, this person receives one payment of $50,000, and then passes away a year later. Well, the insurance company made out like a bandit. The insurance company now gets to keep $450,000 because this person took their money, purchased the annuity contract, and they were guaranteeing it on their own life. The individual took the gamble saying, you know what, I feel like I'm going to live a long time. But he lost because he passed away after a year, and now the insurance company netted $450,000. Or you have the other individual that's healthy that says, listen, I understand. I have my parents, my grandparents, everyone lived into their 90s. I want to take this risk. Meaning that if they had that $500,000 annuity contract, they purchased it, they get $50,000 per year. Well, now they're living. Let's say they live for 40 years. 40 years of $50,000 per year is $2 million. So that person would have been able to leverage the insurance company the entire time. They would just keep living. They lived into their hundreds. It cost them $500,000 to make $2 million. So this is the power that annuities can give to an individual. Now, when you hear single life annuity, this means that the annuity payment is going to be set up specifically for one person's life. You also have other types of annuities known as joint life annuities. Okay? Now, if you're comparing if an individual wants to either turn on income immediately, they could go into a single premium immediate annuity, just like the example I showed, or they could purchase something known as a hybrid annuity, where maybe they want to turn on that income stream instantly. What a hybrid annuity does is most likely it's not going to give you as high of an income stream. Maybe in that example, instead of $50,000, it's going to give you, $45,000. But the major difference is with the hybrid annuity, you get to still control your money. You have restricted liquidity in your first, depending upon how long that contract is. You have restricted liquidity, meaning you could actually pull out from your account value as you're getting paid out that income stream. And whatever's left to your whenever you pass away, whatever's sitting in your account value would be left to your beneficiaries. So that's why I like hybrid annuities, is because I just feel as if the individual has more control. They have more leverage, and they're not just surrendering all their lump sum of money to the insurance company. Because the insurance companies, these companies are smart. They're over hundreds of years old, and they have data for hundreds of years, meaning that they understand to the decimal point if an individual that's purchasing one of their contracts, how long they're going to live till. Maybe it's a 62-year-old male, and they understand, okay, based upon all of our data, if 1,000 62-year-old males are placing money into this contract, we're going to do the calculation based upon interest rates, based upon our general accounts, all these different things, and mortality tables, and then that's how we're going to produce our result of how much income we're going to get them, because they understand the law of large numbers. Let's say out of those 1,000 62-year-old males that are turning on income instantly, well, 990 of them are going to pass away before the age of 77, or whatever that process may be. But just understand that the insurance company, when you're annuitizing your contract, that's what the insurance company wants to do. They want to control the chips. So with the hybrid annuity, what it does is you could still produce the optimal result, but now you get to control the chips. And you don't just want to go into a random hybrid annuity, you want to know which type of hybrid annuity to go into. So that's if you're looking at immediate income. Now, you could also take out a single premium immediate annuity on a joint lifetime income side, meaning instead of $50,000, now they're covering you and your spouse. If your spouse is also age 62, maybe you guys put in $500,000, and now instead of getting paid $50,000 for that one individual for that single life option, maybe now you guys are only getting paid $25,000 for the joint life option, because from the insurance company standpoint, they now have to cover two different lives of payments. One of the ways that you could actually overcome this obstacle, if you're interested in a single premium immediate annuity or a hybrid annuity for that matter, and you say, listen, that's such a big hit, $25,000, I could either get $50,000 if I'm a single or $25,000. I mean, I understand the risk there, but how exactly can I protect myself and my family, making sure that if as long as we keep living, we're getting paid a good amount of money, but if something happens to me, not surrender that remaining amount, to the insurance company. And that's how you could leverage life insurance. In this process, people call it different things. Some people call it arbitrage. Some different advisors call it different things. But essentially what happens is, instead of saying, okay, I'm going to go take the joint life payout, it's going to pay me $25,000, or the single life payout, it's going to pay me $50,000, let me go take the single life payout of getting paid $50,000, and then out of that amount, let's just say you take $10,000 and you purchased a $500,000 permanent life insurance policy on spouse A, on that individual that is getting paid that $50,000. Because when they're getting paid that money, essentially it's going to be shared between both husband and wife. So now these people are netting $40,000, $40,000, which is much higher than $25,000. It's $15,000 higher than $25,000. Once something happens to spouse A, let's say God forbid he passes away, well, now the spouse B is receiving a tax-free lump sum death benefit of $500,000. So that's a way that you could leverage your chips properly, and this is something that you could do depending upon your situation, depending upon if your goals permit it. Or you could even leverage that on the hybrid annuity side. Instead of saying, okay, maybe a single life payout on a hybrid annuity will, give you $45,000, or on a joint life payout will give you $30,000. Well, you could say, okay, listen, out of this, I understand that if I turn on my lifetime income stream and I'm spouse A, getting paid $45,000, well, we understand that as you're getting paid, you still have an account value that's sitting there. So they would determine your $500,000 every time that you're taking out $45,000. It's going to reduce this proportionately if there were no gains into the account that year. So let's say if that person passes away after the first year, well then, in a hypothetical example, they would have $455,000 that would be left to their beneficiaries. With that situation, the individual doesn't just want to stay within that hybrid contract. Maybe they want to also have some protection for their loved one. So they might say, okay, out of this, $45,000, let me at least take $5,000 instead of and purchase a $250,000 life insurance policy, so that if something happens to that individual, the beneficiary of spouse B is going to receive whatever's remaining in the account value and the tax-free death benefit of 250 as a lump sum as well. So now the spouse is being severely protected, and they're also maximizing their lifetime income stream at the same time. So these are just some really, really neat ways that you could set this up. You could set it up where you're turning on income instantly. You could set it up where you could defer that income with the deferred annuity or a deferred hybrid annuity. But the point that I'm trying to make is that you do have options. You do have control on the situation. You don't just have to go into one product, a one-size-fits-all type product. You have to understand with your specific area, dependent upon which state you're in, dependent upon the amount of money that you want to invest, you have different insurance carriers. And the reason why I keep saying insurance companies is because insurance companies are the only ones that could offer annuities. So it's not like you can go to a bank and a bank's going to offer you annuity. It doesn't work that way. An insurance company has certain legal reserve structure and certain tiers of safety that have to be met in order to offer an annuity contract, and that's why they're very, very safe type contracts. Now, if you are interested in either a single life annuity, if you understand, okay, maybe you're age 60 and you want to turn on income at age 66 or 65 or 63, whatever that number is, you could do that on a single life payout option. Through a single life annuity. You could do that if you want to turn on income instantly. You could either do that through a SPIA or you could do that through a hybrid annuity. There's many variations. One of the things that we deemed in-house is something known as the Retire Sharp planning system. And a Retire Sharp being, if at any point in time you want to check out our content, you can look at our website, retiresharp.com. And when calling into our 1-800 number, you're going to be dealing with a specialist. You might be dealing with myself. You might be dealing with one of my advisors. And what we're going to do is we're going to unveil certain situations. We're going to try to get your brain thinking, okay, listen, what is most important to you, for retirement? Is it safe, consistent growth? Is it, max lifetime income? What is kind of your retirement income strategy? Do you want to do it on a risky aspect? Do you want to do it on a very safe, methodical process aspect? And that's what we really specialize in. Is we try to make sure that you're confident in your plans, that you're leveraging all the different contracts, all the different carriers in your specific state, and then on top of it, we have proprietary strategies that we use in conjunction with the contracts offered for your particular age, for your particular situation, to make sure that you're producing the most optimal result. Now, on average, individuals that call our office and we're helping them out with a plan, we go through over 1,200 different scenarios on average. This is why we are A+ rated on the Better Business Bureau. This is why we've always had really good reviews. We've never had complaints, and why we have national recognition. It's because when someone calls into our office, they understand they're not going to be sold anything. They're not going to be charged anything. We give you guys this advice for free. We try to make sure that you are completely comfortable in the process, because with retirement planning, you only have one shot. If you get things wrong, there's no room for error. You want to make sure that you know all the different things, that you can control, all the eggs in your basket, and you control the chips at all times. So how can the individual leverage the different insurance contracts or the different financial contracts out there to produce the most optimal result and make sure that they're winning, in retirement when they need it most? Once again, 1-800-566-1002. We have 24/7 customer service. Feel free to give us a call at any time. Once again, my name is Derek Afasi. I'm the owner of Afasi Financial Group. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to most updated videos. I try to at least give you guys free content. I try to update this on a weekly basis. And thank you very much for watching this video. And I look forward to speaking with you either personally or at least dealing with one of the members of my team. Take care.